It's a great pleasure to welcome Tom Barrack to Stanford as our keynote speaker for the 2008 Principal Investing Conference. Tom?
I like to move it, move it. I like to move it, move it. I like to move it, move it. You like to move it, move it, move
it. What we're seeing, the only thing that I can say after George's introduction is clear I can't keep a job. First of all, I can't tell you what a thrill it is for me to be introduced by George, because we've shared two boards for a decade, and I've learned so much from him, as has the management on the companies whose boards we serve. George has this way of allowing all the titans of industry who are ego battling around the table. You've all seen this amazing psychic phenomenon that takes place. Normal people walk into a boardroom and turn into maniacs. And George sits quietly listening to the presentation, and there's always a CFO and a CEO who have in the back of their mind this one question they pray nobody ever asks. And when George drops those glasses and starts with the words, "Could you explain?" they all dive under the table for cover. He has an amazing ability to do that. When I was asked to be here today, I was thrilled, of course, because it's a privilege to speak at schools that had returned my admissions application unopened many years ago. So I'm really honored. But I was trying to think of what would be interesting and what could I contribute to an otherwise unbelievably formidable group of panelists and speakers who are following. And I decided the best thing I could do is to find something that I may know a little bit more than they know. And I was unable to think of anything except maybe surfing. And I want to give you just the framework of what I'm going to talk to you about is really not the stuff. It's the tools that you need to be able to work and implement the stuff. Which, as years have gone on, when we look at what are the real differences between alpha and beta, what are the real attributes of what all of you who are in school today are going to need in the workforce, and what all of you who are in the workforce need as a competitive tool, it ends up being that you've got to have the clubs in your bag, right? You need to find a discipline, and then you need to start working on the tools. And the golf course will change. The sand traps will change. The fairways will change. But the tools that you develop over time will be what you're able to utilize. So in thinking of a theme, I have three sons, all of whom surf. So for me to spend father-son bonding time with them, it's a mile out at sea in terrifying circumstances. And this last Christmas, one of my sons is a professional surfer, and we were out in Hawaii surfing, and he and his professional pals were telling all the amateurs who had been surfing in 5, 6, 7 foot waves that there was a swell coming up and they should go in at this particular spot that we were surfing. And of course, as is the case, nobody ever listens. And the swells start building. And all of a sudden I'm looking out at sea, I'm paddling out, and I see the sky just go dark. And this rogue set starts rolling in. And there's a whole series of 30 or 40 people caught in this impact zone, and 3 or 4 people paddling up behind it. Needless to say, what happens is that this rogue wave hits, shatters the boards and the leashes. Those boards and leashes go flying, and everybody in the aftermath is diving for cover. And for 5 minutes, you didn't know if anybody survived. I mean, literally, you didn't know if anybody survived. And what came to mind at that moment after I found my son washed up on somebody else's surfboard and everything had calmed down was that this is where we are. This is the moment that we're in today. This is what opportunity fund investing is like. So what I'm going to talk to you about is just some characteristics of great investors, many of whom you're going to hear today. And then I'm going to give you tidbits of what our view is, what our point of view is, of where we are in the world. That'll be like an anchovy on a Caesar salad. You know, the rest of the speakers and the panelists this afternoon will be the lettuce, and they can look at us as the anchovy. Some of you may like it and leave it on, and some of you may toss it away. But first of all, opportunity fund investor, the limited partners who are here will tell you that they make their money in asset allocation. That the decision of where the money goes is the most important decision they make. So whether you allocate to equities, whether you allocate to fixed income, whether you allocate to alternative investment, that major decision is where you really make your money. And then within that tiny tier, everybody has an expertise. Ours happens to be produce extraordinary return. And people would like to tell you that you can produce extraordinary return without extraordinary risk. That's a fallacy. It's impossible. All returns regress to the mean. Professor Parker taught you that in Finance 101. It doesn't work that way. You have to find extraordinary risk, but you have to practice extraordinary risk. And that's the key. So in our business, the ingredients to produce extraordinary returns is be prepared and master how to take and find extraordinary risk. And that's really what we've done. And it's exactly analogous to surfing. I'm going to show you just a clip.
It's not a game. This isn't a joke. It's not like just something that you just go out and do. This is something that's it's serious. This is life-threatening every second. And I think personally, it's incredible to see the lack of appreciation for the power of this wave.
There's a lot of jockeying going on. I can see everybody's just looking towards the right. And, they can't even see that the left even exists at Piahi. So the set's coming. I look to Laird and I go, hey, just set me up with the left. I don't even care about the right. So I take off on this left, and all of a sudden it was much calmer, and there was a bit of just quietness.
It was like now we were able to separate ourselves, because for a while, like the last couple of years, just with all these people coming in, now it's got to a point where it's so chaotic, such a circus, that we can detach ourselves from it in a way.
You know what's funny? I felt more safe with all the sharks over on the left side than with all the people over on the right side.
That's summarized. That's the end of my presentation. Right? It says everything. When you're in the middle of the crowds, the tailwind has been right on our fanny. So for the last 10 years, all of us have been brilliant. Why? Because the momentum has just been carrying us upward only. And the packs and the amateurs join in that phenomenon. And to separate yourself from that pack, to get out of the way, is the key. And I think the last comment was really brilliant, that he felt more comfortable with the sharks on the left than he did in the notion of the harness security on the right. Because we all love to invest in packs, especially those of us who are reporting to limited partners. Because limited partners have to rely on consultants. Consultants have to rely on information. Information is a commodity, right? I mean, we like to say that there's information arbitrage. There is no information arbitrage. You go to the most prestigious school in the world, Stanford, you have a question that you want answered without analytical ability, just facts. You push Google, and the kid who graduated from Culver High has the same information that it's taken you 8 years to get. So if you think information is going to be the edge, I have bad news for you. It isn't going to work. You look at, once you've graduated to big waves, it's like once you've graduated out of business school. You've got to assume everybody's great. Everybody is great. And I have bad news for you. When you graduate from business school, it starts all over again. That heap just keeps waving. The cream goes to the top. Now you have a new cadre of people. They're all good. They're all talented. And that competitive set starts all over again. So in order to distinguish yourself, you have a number of things that you need to do. Harder work, more preparation, more risk, quicker risk analysis. Take the left instead of the right. A combination of all of those things. But you have to distinguish yourself with something. And terror along the way is a good thing. It's a healthy thing. To be complacent, to have hubris is essential. That as you're looking at an investment, as we look at investments, or as we look at our great peers, most of the people who you're going to talk to this afternoon, what they know is where the exit is before the entrance. What they develop over time is an instinct about it, not so much the informational, analytical ability of where it is. And we're going to talk a little later about themes, about developing themes. And what happens mostly is great investors develop the theme after the instinct. They don't create the theme and go out in the world and try and find the theme. And we're going to talk about that in depth. But it's about taking risk, not avoiding risk, especially in opportunity fund investing. It's the key. Anticipation is everything. It's those years of knowledge and wisdom of wandering through those jungles to find elephants and tigers and giraffes that perhaps you weren't looking for, that all go to this cadre of experiential stuff that when you go to draw on is there. And being quick on that trigger and being able to adapt instantly to change your point of view, which is why when I say it's the tools in your golf bag, it's not so much the golf course, it's the key, because it goes from a sand trap to a green in an instant. And if you're invested in just hitting out of sand traps and there's not a sand trap there, you're in big trouble. Avoiding crowded takeoffs, humility, all those things we've talked about before, it's really the key. And adaptability and a cultural sixth sense. I think one of the most essential ingredients for any great private equity investor is their ability to be able to sense the culture. We talk about globalization, but globalization is interpreted by little tiny nodes of localization. So understanding the fabric of what they're in, of what they're doing, where they're going is the key. You know, a lot of this is obvious, but you know, showing respect to those around you and then demanding respect is a very delicate balance. Because humility, unless you are the number one smartest person in the field that you're in, you can be unfriendly, you can be not nice, you can be arrogant, and you'll probably succeed. If you're the number 2 or 3, then you better learn those other attributes. Because people have to like you. You have to figure out how to express your talent and ability, how to be able to use it. So getting into this place where you're extending your own comfort zone, if you extend it too little, you can't compete. If you extend it too much, you're dead. So harnessing this adaptability, this risk tolerance is one of the toughest things. Opportunistic versus strategic. You know, this is a moment, and you're going to be talking about it all day, where no matter what anybody tells you, nobody has any idea what's happening. Every hour is a different situation. And the truth is, it doesn't matter what's happening. What matters is that you have a focus and a point of view as to how to handle the volatility. But most investors go out and create a theme. So they get a cadre of brilliant business school and law school grads, put them in a room, say, come up with where you think the world is going. They spend hours and days and weeks creating a theme. Then they take that theme and they march out in the world and try and get the world to align with their theme. And once you get invested in that theme, you're not paying attention so much to the other things that are happening around you, because you're trying to confirm the theme that you spent so much time and so much effort and so much money investing in. Where really what happens at a time like this is you need to be themeless. You need to react to all those little test tubes that are floating by you without a point of view, just looking for that experiential arbitrage. This is a great book, by the way, for any of you who haven't read it. I mean, Nicholas Taleb also happens to be Lebanese, which is why I'm a little prejudiced to it. So, you know, loyalty to ideas is a very difficult thing. And we all talk about thinking outside the box. I don't think thinking outside the box does a thing. You have to live outside the box. You have to have a set of experiences that have nothing to do with your primary business purpose. It's why for those of you who are motivated by money, if you go and talk to 300 of the wealthiest people in the world, I guarantee you 299 of them will tell you they were never concerned with money. Money isn't what drove them there. Money isn't what got them there. Money wasn't their motivation. It was a passion for something else. Money happened to be the other result of what it was. And so this Renaissance ability, if you look at every great investor in private equity, they're all Renaissance men or women. They all have some unique factors, some very interesting categories. They're all involved in bizarre things because all of those other life experiences bring a point of view that's much more flexible than being an alpha manager to public equities. And I'm not downgrading that at all. The fact that public managers haven't beat the S&P index for any 10-year period since the beginning of time has nothing to do with it, which is true, by the way. some common sense things. Especially when you're in school, long line relationships. When you're building relationships because you need them, they hardly ever work because the world is too transparent. So when you're out concentrating on networking, on cultivating, on building relationships, it's always very difficult. But if you make that a life practice, over time, that karma bank builds up. And the great investors, especially in the private equity world, have spent decades building and collecting those relationships, and they draw on them over a period of time. The accessibility of you to them or of them to transactions is also an unbelievable factor. Is the most powerful people I've found over time are the easiest to get to. It's inversely proportionate to what you would think. It's absolutely true. You want to call Warren Buffett this afternoon and tell him what a wonderful, magnanimous thing it was that he did to bid on the municipal bond portfolio of the bond insurers and to leave them with the CDOs and the CDXs, you'll get him on the phone within 2 or 3 hours. You want to get the vice president of AIG, it'll take you 4 days. It's just the way that it works. After a great education, one piece of advice is what happens is like racehorses. You train thoroughbreds on a track with other thoroughbreds. So you're very careful that they don't get kicked. You want to put them in separate paddocks. You want to make sure that they're brushed and polished 2 times a day. You feed them separately. And then you take them to a track. It's like ultimate fighting, right? You bring a prize boxer who's only been with boxers, and you put him in a ring with a jiu-jitsu Brazilian maniac. And the rules change. So this prize boxer doesn't know what just happened to him. He's on his back, he's on the ground, and somebody's using another set of rules. Well, after a great education, this is what happens when you go out into the world. So you have to, without losing your ethics, get to that edge again. You have to retrain yourself to risk. You have to retrain yourself to the street a bit. And take all those great tools and use them in a more adaptable form. This, I think, summarizes the use of information. This is what we find in our organization, which is the information you have is not the information you want. The information you want is not the information you need. The information you need is not the information you can get. And the information you get, everyone has. So we sit there after months and months of analysis and due diligence, and this is where we always end up. Everybody has the same information. So, you go to auctions. This is what I love. Wall Street is so amazing because we all resisted going to auctions. So now we have our teams will walk in bidding on companies against Morgan Stanley, Goldman Sachs, TPG, Blackstone, Carlyle, KKR, the toughest, smartest investors in the world, and come out high-fiving, saying, this was awesome, we won. We just paid the highest price over the smartest investors in the world. What could be smart about this? Right? It's counterintuitive. It doesn't make any sense.
All the training that I've done with Laird and Derek and Brett and the strap crew and the windsurfing and everything I've done to this point has helped prepare me for a bad situation and to enjoy what I am being given, the rides, the waves. It's not just a matter of surviving, but it's a matter of riding and performing. A lot of these people have skipped a lot of steps because they want to go out and ride this wave, and I can understand why. It's a draw, it's exciting, it's a sense of accomplishment, it's all these things. But I think they might be taking some unnecessary risks. You can't cheat that many steps and think that you're going to be able to pull it off for that long.
And I think that's the bottom line message: is you can't cheat the process. It's time in the saddle. When a wind is at your back, momentum makes everything look great. The wind is now on our head. It's a different time. And those who took the shortcuts, made it look simple, will have a difficult time. What I thought I'd do now is take 10 minutes and just give you our view of the world. I think we circulated at Chairman's Corner that gave you a more in-depth view of the useless information that we can provide on where things are, because, of course, we don't know any better than anybody else. And then we'll have time for questions and answers. But, you know, the long and the short of it is that markets are very predictable. All excesses regress to the mean, but before they regress to the mean, they revert to the other excess. And that pendulum swings back and forth. And we're in the middle of a pendulum swing, and nobody's quite sure where it's going. And the pendulum swing started as an excess driven by accounting, as it's always driven. And the analogies between 1990, which was a time before most of you were born, and at that time, by the way, I had blonde hair and blue eyes. I was devastating. It was amazing. Before we got into this silly business, and now, and the similarities are very close, in that what drove the demise of the savings and loan industry in 1990 was a regulatory realignment of the industry. It took an industry that was a boring mortgage origination business and turned it into a hot financial business driven by capital regulatory requirements and accounting. And that's virtually what's happened now with securitization and derivatives, is banks who have already a very low capital regulatory requirement. So for every dollar of capital, you can borrow against it $10 in the box and $90 out of the box. When you get that off balance sheet with a derivative, you increase that leverage 100 times. So as all good businessmen do, using the tools they have and the accounting instruments that they've got in an upward-only market, they started creating more and more products, and they started to find more and more animals that wanted to eat the product. And they created products to meet that animal. And ratings, a AAA rating, only provides a capital arbitrage, because if you're an insurance company or a foreign bank and you buy a AAA rated piece of paper, you have no capital charge on that investment. Where if I buy a whole loan instead of that securitized piece of paper, I have a capital charge of $3 or $4 against that dollar of capital. So what happened was nothing wrong, just the financial industry doing what it does best, which is carving and creating these products, moving them off balance sheets so they had more capital, feeding the animal what the animal wanted to eat in an upward wind-only environment. You know, that's what happens. But the difference between 1990 and now is it was very simple when you hit a crisis, which you always find. And the crisis was you had a borrower, you knew who the borrower was, you had a lender, you knew who the lender was, you had a piece of collateral, you knew where it was, and you had a series of resolutions. You could foreclose on it, you could have a discounted payoff, you could restructure the loan. Now, all of you are in the wrong school. If you wanted to figure out how to solve derivatives, you need to be in the nuclear physics department. I don't know if any of you have ever read, I'm sure some of you have, an actual description of some of the sophisticated CDOs and CLO structures. You need Inspector Clouseau to try and figure out what's going on. And as a special servicer responsible to then, now remember, none of this, we haven't gotten to defaults. We're not talking about defaults. We're talking about fair value accounting. Is anybody here an accountant? Does anybody here understand fair value accounting? Nobody does. We have the smartest students and alumni in the world. I'm telling you, no one understands fair value accounting, including the accountants. And that's why what you're going to see with the banks is this continual meltdown, because there's no possible way of marking to market long-term liabilities and assets in the manner in which we're doing. So on top of that, you have this bond insurer meltdown. The bond insurer meltdown, everybody's looking and say, well, look what happened to Magic today. Look what's happening to AMBAC. Look what's happening to FGIC. No problem. You can have all the bond insurers go broke, and at the holding company, the bond insurers, it's not such a big problem. There's only one problem, is underneath that you have $189 billion of guaranteed debt that's held in other banks. So when Societe Generale's debt, I mean, this was one of the greatest things. I love America. You watch CNBC after this kid, by the way, you want to hire this kid. Anybody who could figure out how to do $7.9 billion. Right? I mean, this was a feat. This wasn't some small little task. And all the commentators come out and say, this is the greatest thing that ever happened. It shows the economy is healthy. Because they didn't lose the money in derivatives, they lost it in fraud. It's unbelievable. So the real problem with Societe Generale is AMBAC and FGIC have $76 billion of rated Societe Generale debt against $40 billion of capital. So a downgrade just puts them gone. They're just gone. It's just history. So, and we could talk on about, we talked about Warren Buffett's offer on on buying the municipal portfolio. It's a smart business move for him. It makes no sense for those companies. So you have this banking problem, which is write-downs, but that's not really the problem of what's happened. The problem is what happened is what do they do for revenues? So you're taking write-downs. They're trying to look in their rearview mirror and say, okay, we've got all these problems. We need to fix the problems. In the meantime, there's no IPO business. There's no M&A business. There's no mortgage business. You'll see some of the big investment banks get out of the securitization business altogether. And you could see this being the beginning of the end of AAA-rated securities. And we can talk about that more later. What is the purpose of a AAA rating from groups who have proved themselves to be totally unreliable in every instance? And the market will react to this over time. Coupling and decoupling. And you're going to have a globalization panel with people who are much smarter at this than I. Our point of view is absolutely everything is coupled. There's no such thing as decoupling. So when you increase the consumer's ability to buy in America, Flip and I were talking about it before, you might as well just write the Chinese a check. Don't give the American consumer the check, just send it to China, because that's where it's going to end up. So the reliance of everybody on everybody in this soup is there to stay. All of the governmental intervention, it's the same thing that it was in the 90s. It only postpones the inevitable. The inability for the American government just to let the market take care of this, flush it all. Let the foreclosures go to foreclosures, let the bankruptcies go to bankruptcies, and the market will mark itself to market in an instant. Project Lifeline, allowing all of these foreclosures 30 more days. And poor Hank Paulson is one of the most brilliant guys in the world. He couldn't even read his script. He was so disgusted with himself as he's reading this new brilliant Bush proposal. It's unbelievable. The Fed intervention, the fiscal package, it's all just postponing the inevitable. And in fact, you see it in the market. Because all of these things are supposed to instill confidence, and what happens is mortgage rates go up. Hillary Clinton comes and says, well, great, we'll just put a moratorium on interest rates for 4 years. It'll be great. Nobody will have a mortgage on their house in the world. Right? You'll just destroy the mortgage market in its entirety. So it's a tough time. Sovereign funds, what's happened is if you look at Citigroup, for instance, internal cost of capital about 2%. They needed capital in an afternoon. They go to 2 foreign fund investors. They get the money at 9 to 11%. Without the sovereign funds, and of course Americans are yelling, oh my God, we're being taken over by the Arabs. But let's pay them another $1 trillion a year in windfall petrodollars for the oil that we have. You know where you all should be? We all should be in Dubai right now with Stanford University of Dubai. How many of you have been to Dubai? Is it the most amazing phenomenon you've ever seen in your life? It's incredible. It'll probably be a disastrous, ugly ending. But at the moment, all of the money in the world is going there. Abu Dhabi is the richest per capita country in the world. And no matter what we do, we're sending our dollars there and trying to recycle them here. So who owns all the debt of America? We have $13 trillion in debt, the Arabs, the Chinese, and the Japanese. And we're worried about intervention of them taking a total position in one of our banks. We're not worried about them owning the $9 trillion of debt or the $5 trillion of the stock market and mortgage market that we have today. It's incongruous. We want them to open their markets to us, and we want to close our markets to them. The bottom line, I think, our take through this is it's not a liquidity confidence crisis. It's a confidence crisis. And this distribution channel of how financial product gets disseminated and the regulatory environment which it's hold is really, really in trouble. So, what are the best places to invest in? Our view is the greatest long investment is America. If you look at the dollar against every other currency, it's cheap. It's going to stay cheap. There's no other solution. The dollar has to remain getting pounded. What happens when that happens is inflation. And inflation will rage as it always rages. So if you look at all these ingredients of an emerging market, the U.S. is probably the best emerging market. If you look at all of the emerging markets that people have talked about before, and you're going to have a lot presented to you this afternoon about China and India. China and India, obviously for growth, are a place that you need to be. It's hard to find Westerners that have actually exited those markets with money. Those are two very sophisticated places with very sophisticated investors that don't really need capital. The difference between the two is in India, you have an average tenure of a real estate development company of 2 years. But every graduate speaks English. So every graduate from India gets on an airplane with a package of a township that they want to promote to some U.S. entity. In China, you have hardly anybody that speaks English, and you have development companies that have been there for 25 years. So nobody gets on an airplane coming here with a package to present to a U.S. investor. Either way, none of the U.S. investors in massive terms have done very well in those markets. The markets that are starting to explode are the Middle East and Russia. Very difficult to penetrate, takes a long time to build those relationships, and it's a little bit counterintuitive. But I think you're going to be short Japan, China, Korea, long the U.S., Middle East, and Russia will continue to be dominant places. The amazing thing in the middle of all this is the general economy is actually quite good. A lot of you probably saw the retail numbers that came out of the fourth quarter. Retail numbers are great. Walmart, Home Depot were up. It's this incongruity of what's going on. So I think the bottom line is that nobody has any idea what's really happening. And the good news for investors, which I think you're going to hear throughout the day, is America's resilient. The investors who are going to speak to you today are amongst the smartest and the best that have the mobility to move through these volatile markets. And as long as there's volatility, there's tremendous opportunity to be had. We've kind of talked about all this in the parades of horrible, which you're going to hear during the day. The trickle-down effect. The reason I think this is so much deeper, I was listening to a lot of the commentary this morning. They're saying it's over, the shorts are off, everything is fine, go out and spend again. I was looking for Jim Herbert at First Republic to get another jumbo loan on a new house. I think it's all garbage. I think when the March results are in, when this quarter is in, it's going to be a disaster. And that trickle-down effect, when you start really getting to defaults, you haven't gotten to defaults. You know, you're going to hear, you've got some of the best LBO and private equity investors here this afternoon. There's challenges. You can't pay a 20% premium to a company that was at its historic high, put 5 times leverage on it, have the market then evaporate 30% of your market cap value and say everything's great. It's not going to be great. CLOs, CDOs, CMBS, RMBS, all challenged. As that moves through the system, there's going to be huge problems. Sometimes when the water's too turbulent, you have to concentrate on something easier. and this is it. So I think my last message to you, and then we'll have some questions, is, you know, every morning a lion wakes up in the jungle and knows that it has one thing to do. It's got to run faster than the slowest gazelle. And every gazelle wakes up and knows one thing, that to survive, it has to run faster than the fastest lion. So whether you're a lion or a gazelle, you better get up and start running. That's the bottom line. Thanks. We've got about 15 minutes or so for questions. Yes, sir.
You mentioned that when you go into an auction, so that setting up against all the other activity, and you always win because you pay the most price. So what's the solution? Simply like not going to auction because you're gonna be like the bigger fool, if you want to say that, or or you simply deal with it.
The question is that. I've said going to auction, you feel foolish. And since auctions have been the vehicle of choice for Wall Street in the last decade, what's the solution? If auctions don't work, then what is the solution? And I think the answer is, in an upward market, auctions work. Because what happens is everything you would have bought in the last 10 years, and I think all of us, all around these panels today, have to be honest with each other, is no one knows, were they brilliant or were they lucky? And the truth is, it doesn't matter, right? If you're an investor, I mean, we're stewards of limited partners' money. So as long as we're producing results, whether we were lucky or whether we were smart is irrelevant. So in that node, going to auction, when you have all of this ability, when you have these teams that can actually create value, so you have a financial engineering package, you have an acquisition package, you can compensate management differently, you can increase EBITDA, you have an exit. And the exit in many of these instances for the last few years have been dividend recaps, refinancing recaps, right? So we've all lived off credit. It's just been a credit arbitrage. Is that debt has been cheaper than equity. The stock market's been idiotic, right? When you think about it, it makes no sense. You go out and you have a multiple on a company of equity investors with the equity, and you can replace that equity with debt 600 basis points cheaper. So, I mean, this was the arbitrage. So it did make sense, because as long as that debt was available, then the parade of returns could continue. Now we have a different situation. So even though it felt awkward at the time, it was absolutely the smart thing to do, because every CEO of a company would never think of auctioning. And it's, of course, why are the CEOs auctioning their companies? Because these guys are sitting here, having gone to great business schools like this, managing thousands and thousands of employees, and they're watching these private equity guys driving Ferraris, going to their homes on the beach, and their options are going down the tubes because the public equity market wasn't giving them value as CEOs for what they're doing. So everybody said, well, let's jump ship. We want to be on the private equity side. So the private equity guys say, great, we're going to make you even richer than you are. Here's the compensation package. Here's what you're going to do. Here's what the piece to promote. And the market did what it did. So I think that's now changed. Private equity will react very quickly. There'll be a new gig on the street, less leveraged, a different set of tools, just like they switched to pipes and toehold positions. There'll be a new set of financial criteria, and they'll take all the great tools they have of knowing how to manage, knowing how to buy, knowing how to be really more servicing to their investor base than a public equity company. When you look at public equities, we said, well, the reason that you pay this liquidity premium because you get transparency, you get a professional management team, you get liquidity. We've proved in the last 10 years none of those things are true. There's hardly an accounting firm left alive, right? We thought accounting was the method of responsibility and transparency. What we found is a 5-year period, every accounting firm went bust. They went bust because of lawsuits. You're going to see the same thing happen in investment banking. All these people who bought derivatives, I guarantee you that the little sheikh sitting in Abu Dhabi who is buying $750 billion of these derivatives never read the book. You get a blue book, Morgan Stanley, Goldman Sachs, Citibank, and they create a secondary market. They think they're buying a security. Now, when all of this slows down and all of a sudden these lawyers sit down and say, you know, we just lost $1 trillion, I guarantee you the lawsuits that are behind this are going to make what happened in the RTC look like nothing. So the wave on the wave on the wave is complicated. Auctions will always be there, but private equity will figure out something else now, because without debt, it's got to be a different gig. Yes, sir.
You mentioned that Dubai would probably end badly. I was curious if you could give a little bit more color on that, and what you think about the Middle East in general going forward.
Yeah, the question is, I had mentioned that Dubai will probably end badly, and what's the rationale for that? Number one, I'm a big supporter of Dubai, but just to give you a little bit of a background, you have 7 Arab Emirates that were a consolidation of 7 tribes that were put together by the British, because you have 300,000 Emiratis, 300,000 citizens who are the richest citizens in the world now as a result of the British having discovered oil in Abu Dhabi, which is a separate fiefdom. So the only one of the 7 Arab Emirates that really has spendable capital from natural resources is Abu Dhabi, not Dubai. So Dubai, in order to find its own place, brilliantly and shrewdly decided that it would become the commercial capital of the Middle East. Lebanon was war-torn. Cyprus was inefficient. The bureaucracies existed everywhere else. So they went to Singapore. And they basically hired the Singaporean government and said, we want to create a new country. So in 10 years, you have best of class of everything. The best airport, the best hotels, the best golf courses, the best tennis courts, the best technology centers, the best everything. But the underpinning of all that has not been windfall petrodollars. The underpinning of that has been the sale of residential and commercial property. So if you're an Iranian sitting across the Straits of Hormuz, all of you probably remember your geography. Abu Dhabi sits on a point. 3 miles across from that point in the Straits of Hormuz is Iran. So you have Iranians sitting there saying, you know, on a bad weekend, if Israel launches a nuclear missile, we're going to have a really tough time swimming across this 3 miles to get to Abu Dhabi. So Dubai said, great, what we're going to do is for everybody who buys $1 million condo, we're going to give you residency. So now you have 300,000 Emiratis in the Emirates, and you have 6.5 million people, employees, residents, part-time residents, not occupying all of those units. So when you look at the natural element of Dubai, it's unbelievably successful. The people are unbelievably smart. The product is fantastic. But the excesses of the speculative thrust will probably have a consequence at some point. So when I say a great disaster, I'm a believer that Dubai is there for the long term. And Abu Dhabi, if Dubai gets in trouble, even though it's been building on a leveraged basis, Abu Dhabi, with one day's pumping, can bail out Dubai from all of its vagaries. So I think the Middle East is here to stay. As long as you're burning motor fuel, no matter what we say about alternative energy, it's not really going to make a difference. China in one day burns all the oil that you can save through every kind of ethanol or alternative energy manufacturing process that you want in your automobiles. So when you look on a global basis, it's going to take 30 years to fix that problem. So I meant it off of Kevin when I say it's an excess. There's so much building. There's more cranes in Dubai and China today than everywhere else in the world times 2. It's amazing. Yes.
You mentioned in your chairman's corner that municipalities are going to have to search for new channels to fund their projects as traditional channels become too expensive, and that this is a great opportunity for infrastructure funds. Do you also see it as an opportunity for Colony, or does it not produce the returns that you require?
Great question on infrastructure. With the municipal bond dilemma, that infrastructure is going to be a new project finance opening. Is that an opportunity for Colony? And the answer is yes. But it's like pulling into a gas station and needing a different octane fuel. Private equity and opportunity funds have been geared to 20% plus returns, and the world has corrected itself. So when a deal walks into our office in Singapore, it doesn't know what it is. It doesn't know, is it an opportunity fund deal? Is it an infrastructure deal? Is it a value-added deal? Is it a LBO? It just knows it's a deal. And we've all bifurcated ourselves into these little Chinese menu alternative asset groups. But what's happened is the big guys are all going to multi-platform. So if you look at Carlyle, TPG, Blackstone, they have a diversity of funds, so their investors can invest in those funds with just a lower cost of capital. But the deal sourcing pipeline, which is the only place that you really differentiate yourself, because they're all smart, they're all brilliant, they're all great at what they do, it's how they source it. So I think that there's a huge opportunity in infrastructure, because what's going to happen is this arbitrage of having a bond insurer, which gave it 2 ratings. I mean, remember, it was already AAA rated. So now you had a bond insurer which just allowed that capital regulatory piece of buyers out in the marketplace will be gone. And the AAA status itself is threatened. So project finance for all those municipalities as they're searching is going to be a big arena. And we'll participate. We'll just participate with a different kind of fuel. It'll be a separate definable fund. But I think what you're going to see is infrastructure funds will be the flavor of this year. It'll be a great place to invest. Yes, sir.
When things started to break in late July, August, September, was the thought process that you went through to sort of process what was happening? What was the evolution of your forming the understanding that you got?
The evolution of our thought process was, it started with a sneak preview at the credit market. We had never seen the banks starting to act the way. This is before subprime, because subprime is a misnomer. Subprime was just the peek under the covers of this redistribution of credit that had gone on. And I think most of us had realized that the frenzy of lenders, the risk that lenders were taking as they moved up that loan to value, or as they moved up the multiple of EBITDA stream, was becoming insane. And the reason it was becoming insane is they weren't keeping on their balance sheet. So it was originate and syndicate. The banking business had changed. It was no longer matched assets liabilities. It was create sieves and all of these Casper financing vehicles where they could create unbelievable exponential profits without ever hitting their capital Tier 1 and Tier 2 requirements. So I think the first place that we all started to feel it was the banks started to back up on their commitments on our corporate deals, which they hadn't done. I mean, for the last decade, they had always held our feet to the fire as to these commitments, and none of us had ever had any need to hold them to the fire. And what happened is they started coming back. You've all heard covenant light. Well, we used to borrow money 10 years ago. You used to borrow money, and you had a whole series of thresholds which you had to maintain within the operating companies, non-financial default. So if something was going wrong in the company, the bank had recourse to you for either more collateral, for asset sales, for something. As competition went on in the industry, they went to covenant light, which all of the negotiators, the users of the product, said, we're not going to give you those covenants. Lend us the money, and we'll pay you back the money. That's what you're going to get. And the banks, in the frenzy and the easy distribution of that product all over the world, did that. So I think the first indication was we saw the banks backing up. And then as you started to look through the system, the confusing thing was the economy was pretty good. Everybody's business, I think what everybody will tell you today is all the private equity guys are going to say their businesses are fine. You don't see it in the business. Usually you see it in the business. You see it in the financial structure. The capital structures are strained. And it's not even on the default structures. The defaults are all as a result of these downgrades. It's not as a result outside of the residential mortgage cycle, which always happens, right? I mean, the difference in the residential mortgage, which we weren't panicked about. We knew foreclosures were up, and home builders are always a sucker's punch. And I'm not offending any home builders, but if you look at what you're buying, it's the worst manufacturing business in the world. They operate at 5 or 6% margins, right? You've got to go long on real estate, out 10 years to have inventory. It takes you 7 years to get entitlements. You can't build houses manufactured in advance because you get stuck with inventory, and you're in the cyclical ebb and flow of the mortgage markets. So I don't think too many people paid attention to what was going on in the residential market, but no one had any idea of the far-reaching implication, including the banks, by the way. The banks did nothing wrong. I mean, there's no culpability here. They were manufacturing product that was being digested by a world who had become drunk on credit. It's what all of us had done. America was the epicenter of credit consumption. And now what we're doing is we're trying to retrain ourselves. We're all in rehab, right? I mean, I think everybody here, everybody who's on these panels will tell you we're all in credit rehab. And it's a difficult thing to digest because you have to teach this pony a new trick. So the analytical process, I think, is just to have some volatility. Quite honestly, we were elated because it had been a long time that we're dealing with amateurs, and amateurs taking undue risk were producing higher returns. And when you're being judged in the same category, it's very frustrating. So having a correction is a healthy thing, is a good thing. And it produces another whole set of opportunities, which if you can adapt and you're not trapped by the prison that you built in the past, can be phenomenal. But I think it's still unfolding. Anybody who tells you that they know what's going on, it's inaccurate. I mean, this is going to be a very volatile 2008. Very volatile. Yes, sir.
massive investment in our stock market, but we were maybe uncomfortable with investment coming into the banks. Over the long term, do you expect there to be a backlash against foreign investment in the U.S. equity market, particularly from the Middle East, or do you expect it to be the inverse, that will be more open to that?
Unfortunately, I think the reality is there will be a backlash, which is the wrong answer, right? I mean, what you'd love is through this experience to create a new bridge of tolerance of this natural distrust between the East and the West. And that bridge of tolerance would be built on the backs of commercialism, where you don't have any of these political or religious points of view. But the distrust on both sides is startlingly eminent, because the Middle East, I mean, as all of you know, there is no such thing as the Middle East. You have 50 countries with 100 languages and 300 religions, and they hardly agree on anything. They don't agree on borders. They don't agree on religion. They don't agree on language. They don't agree on anything. And they all have different points of view, and they all love America. They all love America, and they all love Americans. At the moment, many of them are a little confused about America's political policy to them. They didn't go looking for Citibank. They didn't go looking for UBS. They didn't go looking for any of these institutions. They came to them. And they responded with no governance, no board seats, no tools, which we've all in the private equity said, are you guys crazy? We'll invest with you, but it's too soon. It's a falling knife. Don't invest at this point. Wait another 10 minutes. We'll invest with you, and we'll bring with you the tools. So they've invested naked in these entities alongside of management, right? And why did management go to them instead of us? Because management wanted to keep their job. Right? It's that simple. So my hope is that through this, there'll be another huge bridge of tolerance, because the Middle East for the next 10 years, we better get used to it, and we better learn how to deal with them. And it's the epicenter of the world for the financial, for money and financial matters. It's on its third generation. They're getting good. They're smart. They're mostly Western educated. I think most of them are well-meaning. They can be great partners. But America will always misplay its hand, especially in the midst of terrorism and all the difficult things we're dealing with. Thanks. Thank you.